The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Live from Studio 2 at Bloomberg World Headquarters in New York, I'm Scarlett Fu.
And I'm Bonnie Quinn, and we're kicking you off to the closing bell here in the United States. So let's have a look at how we're heading towards the close. The S&P 500 up 0.6%. That's off our lows of the session. But as you can see, the Russell 2000 up 1.3%. So a much better day after that jobs report, a blowout jobs report, a dinger, according to Michael Feroli of JP Morgan Chase. The Russell 2000, obviously the smaller and mid-cap companies doing much better on enthusiasm for the labour market and how it's withstanding any of the challenges that are out there. Look at the repricing on the two-year yield. We're talking 22 basis points today. We're at 3.928% now, headed for 3.93%. What a repricing. And the NYMEX crude, you'll notice we are still up by about 70 cents, almost 1%, but we're lower than $75 a barrel. And this because Joe Biden, the president, just said that he thinks that Israel should think twice about hitting any Iranian energy infrastructure. And that had been a question in the market's mind over the last 24 hours, Scarlett.
Bonnie, you mentioned that the jobs report was a dinger. How about a grand slam? Stronger than expected growth in payrolls, positive revisions to previous months, and the September jobless rate declining. Maybe this is what an actual economic soft landing looks like. Now, the hot print forced traders to rip up their bets on outsized rate cuts in November and December. Treasuries sold off. That sent yields sharply higher, especially at the short end of the curve. Mohamed El-Arian says the jobs report serves as a reminder that the Fed cannot claim mission accomplished yet.
For the Fed, it means push back much harder against pressure from the markets to put you in the single mandate box. Enough talk about inflation is dead. Inflation is not dead. Enough talk about the Fed should only be concerned about maximum employment. It should still be concerned about its dual mandate.
And something that could reignite inflation, higher oil prices. WTI topping $75, closing out its biggest weekly gain in more than a year. If Israel retaliates by targeting Iran's oil facilities and Iran disrupts supply routes, does that put oil on a path to $100? So these are questions, Bonnie, that the market's grappling with. But obviously, the main thing we're seeing today is that traders are pressing the reset button on rate expectations.
Absolutely. If you look at the front end of the curve, Scarlett, the two-year yield moving 22 basis points in literally just a few minutes. But you can see it in graphic form if you look at this chart. The purple line is Fed expectations through December. The yellow line is just for November. And you can see this massive move and then yet another massive move. We've gone from literally 120 basis points of easing as the hypothetical scenario that markets were firmly pricing in to literally less than 50. And just for November alone, we've gone from, more than 2 just back in the middle of September to now less than 1. So we'll see how that continues on into next week. But certainly markets taking a big turn today, Scarlett.
It certainly has. All right, let's kick things off here right now with Eric Van Nostrand. He is chief economist with the U.S. Department of Treasury to get his take on the jobs market and the economy at large. Eric, so good to see you here. Thank you.
Good to be with you, Scarlett.
So as we're calling it a blowout jobs report, a grand slam, however you want to characterize
I heard
it. A dinger, yep, that as well. What grade would you give this jobs report?
Well, I'm an economist, so I always have to be careful. So A-pluses are always a pretty high bar, but this is a real blockbuster if we've ever seen one. Today's jobs report confirms a few trends that we've seen emerge in the labor market over the course of the year, which is that the economy is really firing on all cylinders. It's underpinned by strong consumer spending, but also strong business investment. And we're seeing this persistent strength all at the same time that inflation has come down significantly, something forecasters really didn't think could happen even 2 years ago.
So this was a clean report, but it might be the last clean report for a while due to hurricanes and strikes as well. How much can we really extrapolate out these September numbers into the months to come?
Well, it's a great question because we at Treasury always try to look at the long run when we're assessing the labor market strength. And if you look at what's occurred over the past 2 years, we're coming out of an environment, and even just in 2022, where forecasters thought that in order for inflation to get down as much as it has over the course of the past years, that we need to see growth grind to a halt, that we need to lose employment. In fact, what we've seen is at the same time that inflation has come down significantly from its peak, more than 6 percentage points, we've added 7 million jobs in the past 2 years, and GDP growth has grown about 3% at an annual rate, much beyond what forecasters thought. That combination of strong growth at the same time inflation comes down, that's what wasn't in the forecasts a couple years ago, but it's really a testament to the resilience of the American consumer and business investment that we've seen it materialize.
How long for can this continue? Because we even saw wage growth that was better than forecast today, 0.4 month over month and 4% year over year.
Well, the wage growth in particular is one of the highlights, in my view, of what we've seen in the labor market over the past year. Wages have been growing faster than prices for the past couple years. And even as we've made this progress bringing down inflation, real incomes for Americans continue to tick up. So even though we have an environment where costs are still too high for Americans, given the inflation that occurred right in the wake of the pandemic and the ensuing supply chain episodes, we've seen strong wage growth encapsulated in this month's report, which means the typical American household can afford more goods and services today than they could before the pandemic. And that's key for the administration's goals.
Eric, how surprised were you? And by extension, I'm talking about the administration here, right? No one really foresaw this. Very, very few people.
Well, we don't like to point out the old forecast too much, but I think it's important to highlight that President Biden has been consistent. My boss, Secretary Yellen, has been consistent over the past couple of years, saying that there is a way for us to get to strong growth even while bringing down inflation, recognizing, as you said, Vonnie, that was well outside the forecaster mainstream. The way you do it, and anyone who pays attention in Econ 101 knows this, is by growing supply. You can keep demand strong while cooling prices if we're expanding supply. And those are the sorts of investments that the administration wants to make in the years to come in areas like clean energy and manufacturing and other ways of growing our housing supply and generally creating space for continued growth, even in a disinflationary environment.
Okay, you mentioned supply and demand dynamics. Let's talk about that as it relates to oil, because certainly we have geopolitical issues that are moving oil prices higher. How are you thinking about the situation in the Middle East and what that means for oil prices, the continued support of oil prices, and that as a driver for inflation going forward?
It's a great question because oil supply and demand dynamics are central to those main kitchen table conversations that American families are having. How do we keep costs down for families? Over the past couple of years, we've had a lot of geopolitical escalation, including Putin's barbaric war and the challenges in the Middle East over the past year. Obviously, our main focus is on the human suffering in Gaza and Israel and Lebanon and elsewhere in the region. But what we've done over the past couple of years to help protect the American economy from those sorts of challenges is we've seen oil production here in the U.S., our domestic production, almost double over the past couple years. Last year, the U.S. produced more oil than any country ever. We're also the biggest exporter of liquefied natural gas. More domestic supply, it's really the same theme as our housing policies. Growing supply is like an insurance policy against actions taken by Putin, by the Ayatollahs, that threaten to disrupt global energy markets. By keeping that traditional energy market supply strong here in the United States, at the same time that we're investing in clean energy to push down the costs of those cleaner investments, we can deliver lower costs for Americans at the same time that we insulate ourselves against climate change and global geopolitical threats.
How concerned are you that really almost everything improved with the exception of manufacturing? So manufacturing jobs did go down last month. And then there's also the question of potential revisions downwards, right?
Well, I'm glad you raised manufacturing because manufacturing is really central to how we're thinking about understanding the evolution of domestic demand in the years to come. What we've seen over the past couple of years is a tremendous boom in the construction of manufacturing facilities, basically factory building. It's what's spurred on by the CHIPS and Science Act, by the Inflation Reduction Act, which channeled private capital towards building more factories. Now, what we've seen so far is a big boom in construction jobs, and we saw that even this month in the jobs report. Because what we're seeing now, just 2 years after the IRA was passed, we're seeing a lot of factory building, constructions of these manufacturing facilities. It's when those factories come online in the years to come that we're going to see that job boom transition from construction jobs to manufacturing jobs, particularly in the clean tech sectors where it's important for our national security and for our climate to focus the economy.
All right, good stuff. Eric Van Nostrand, thank you so much for joining us. Eric is chief economist with the U.S. Department of Treasury, based here in New York. Now, coming up, a bottleneck broken, with dock workers agreeing to suspend their strike until January 15th. We look at the likelihood of a deal between the union and port employers before the new deadline.
Plus, Spirit Airlines stock struggles as its creditors also struggle to reach a rescue deal. We'll look at what happens and what could happen if the airline's efforts to restructure its debt fail, what bankruptcy protection could mean for the entire sector.
And we take a look at tech, crypto, and everything in between with Cathie Wood, founder and CEO at Ark Investment Management. All that and more coming up. This is The Close.
The S&P 500 up 20% so far in 2024. Elena Hernandez, principal at GenTrust, believes, based on GenTrust analysis, that while half the index's move this year is due to a rise in valuation, the rest of its move comes from earnings, with big banks kicking off a fresh cycle next Friday. Let's bring Elena in now. So, Elena, should that scare us or make us more confident, given that we're about to enter a new earnings round?
I don't think it should scare us. I think it should make us mindful of really what we should be expecting and what the market is pricing going forward, right? When we look at the second quarter earnings, they beat by 4%. Earnings growth was roughly 8%. But I think going forward, what gives us maybe at GenTrust a little bit of caution is the expectation that the market has that this is going to continue. If we look at Bloomberg estimates, right, for example, for the S&P 500, we have earnings expected to be higher by 10% from 23 to 24, and then another 13% out to 2025. So the question is, can these companies really deliver that growth continuously?
And does the market price that in, even if they do, right? I mean, the last earnings round wasn't so bad, and yet we didn't particularly see the market move higher on it.
Well, the market has priced that in, right? If we look at PEs right now, they're at historically high levels at 21, right? And then when you look kind of deeper into those numbers, you realize that the top companies of the index, the NVIDIAs, the Amazon, the Googles, right, the Microsofts, the ones that we know of the world, are really carrying this PE higher with PEs close to 28, while the rest of the S&P is closer to 16. And again, for us at GenTrust, the question is, can this continue? This is the reason why we're currently underweight the equity market, just trying to see if this is sustainable going forward, looking further at economic data and trying to get a better sense of where we are and what's the path forward of the economy. Considering also that historically, when we started easing cycles in the past, when the Fed has done that, we had seen a drawdown of around at least 4% in the S&P, and that's not the case, obviously, with these easing cycles start.
Yeah, I look at what happened today and the reaction that we've seen to the better than expected jobs report. For stocks, good news, good economic news is good news for prices, not so for treasuries. If we continue to see bonds falling and yields moving higher with 4% now in reach for the 2-year and the 10-year, at what point will those higher rates start to become a weight and become a drag on stocks?
Oh, absolutely, right? One of the reasons why, exactly what you're saying, the stock market pretty much hit a high the day after the Fed cut 50 is exactly because of that, right? Traditionally, when you are in an easing cycle, and if you kind of zoom out for a second and look 12 months ahead of an easing cycle after the Fed has started cutting rates, you get a median return on the S&P of like 17.5%. We actually just did analysis looking back at easing cycles since 1984 and how this number looked, and that's kind of the case. Now, I think what's tricky this time, it's a couple of things. One, it's our opinion that the market really got ahead in terms of how many easing, total easing the Fed really had to do, considering how strong the economy still is, right? Mm-hmm. When we were pricing 200 basis points of cuts prior to this labor number, now we're closer to 160, which is closer to the Fed's estimating the SEP, with ending with Fed funds in 2025 around 320. I do think also another point of potential pressure for the fixed income markets, and that you brought it up, it's really the fiscal picture, right? The deficit picture. We're currently running around 6% of GDP, and we know both Democrats and Republicans' plans put more pressure on the deficit. So we have to see the probability of any of those plans passing, of course, but I think that's something that it's going to catch investors' attention going forward more and more in the months ahead.
How much second guessing is there when it comes to what the Fed did and how it moves forward? I think about Larry Summers, a former Treasury Secretary, tweeting out that the September 50 basis point rate cut was a mistake. And we know Mark Rowan, the CEO of Apollo, earlier this week told us that financing is available, real estate prices are going up. It's not clear that we even need more rate cuts.
Well, I think the Fed has been really clear in telling us that they're going to keep acting data dependent, right? I think today's report and the market's reaction is correct, really signals to the Fed that they don't really need to jump again and potentially do another 50 and continue kind of in that train. They could really slow down the cuts. The labor market is clearly still strong, at least for one data point, which was today, and we'll continue looking at others. And I also think that there's the other side, like Mohammed previously said on Bloomberg, when you have average hourly earnings up 4%. So they also have to be cautious and kind of try to continue flying that plane into landing correctly.
Yeah.
With the, dual mandates they have with employment and inflation.
Well said. Elena Hernandez is a principal at GenTrust. Thank you so much for joining us today. Have a great weekend, Elena. Coming up on Bloomberg Markets, The Close, a tentative agreement to halt the U.S. dock workers' strike, sending shares of shipping stocks adrift today. More on that next. This is The Close. It's time now for our top calls to look at some of the big movers on the back of analyst recommendations. And let's start with CVS, an upgrade to buy from hold at TD Cowen. The price target getting a huge boost to $85 from $59. The analyst says the release of the 2025 Medicare Advantage plan shows CVS saw meaningful reductions in OTC benefits and dental allowances. He's now more confident in the CVS turnaround story, which could lead to double-digit profit growth next year. The share's up 2.75%. Dine Brands is next in line, the operator of restaurant chains like Applebee's and IHOP. We're talking about Truist analyst Jake Bartlett cutting his rating to hold from buy and slashing the price target in half to $37. He cites concerns about sales trends, especially since comp sales at Applebee's is severely underperforming compared to the broader industry trends. Shares down about 1.6%. And finally, JP Morgan keeping its underweight rating on Zim Integrated Shipping. The analyst telling investors the short duration of the U.S. dock workers' strike will have limited knock-on effects to global supply chains. She expects freight rates to normalize, but notes that shippers like Zim could come under pressure from risks that never materialized. The share is down almost 13%, and those are some of our top calls.
Scarlett, that's right. Dock workers at U.S. East and Gulf Coast ports are moving cargo again, halting their strike while they negotiate on a new contract. Global shipping stocks like Zim, as you said, falling as investors who anticipated a more prolonged labour disruption process from the sudden news sell. Let's get more insight now from Alan Murphy, CEO and founder of Sea Intelligence, which provides research and analysis of trends across the shipping and freight industry. Alan, how do you do your job every day these days? Because it seems like there are so many cross currents, pun intended. We have the Strait of Hormuz, we have the Houthis now coming under fire when they weren't before, they're still attacking. And then you have sort of more domestic issues like this dock workers strike. What are these container shipping companies supposed to do in terms of forecasting revenue and so on?
It has become incredibly complicated ever since the onset of the pandemic. We kind of thought when the pandemic slowed down, we were heading back into normal, more calm waters, if you pardon the pun. We are now in a situation where even analysts such as ourselves, we wrote a perfect analysis in the mid-December last year saying that the next 5 years would be dominated by capacity shortages. And then the Suez Canal got closed because of the Red Sea crisis. And now we're in the complete reverse picture where we actually have a shortage of capacity in the industry. So it's difficult for us to do it for a living. I think it's very difficult for the shipping lines also to adequately predict some of these events. I would say an event like the strike that we've seen in the U.S. East Coast is somewhat predictable in that the contract has an expiry, and everybody knew that it was coming up here to October. I think we were some of them that raised the greatest concerns of the potential impact if this strike had dragged on. But fortunately, the world didn't end. It came back to us after a 3-day strike. But the devastation could have been horrendous if this had lasted for several weeks.
Alan, who's doing well in this environment? Because for a time, you didn't really want to be a Chinese shipper. For a time, you definitely didn't want to be a shipper that emanated from an Israeli port of any kind, of any origin, because you were a target. And now it's also Russian ships. It's also, so where are the companies based that are doing well in this environment?
Well, it should be said that leading up to the pandemic, we had basically a decade where most shipping lines fundamentally lost money every time they shipped a container, which is, not the best business model if you are a shipping line. The pandemic saw a massive change in that. In rough terms, the 15 largest shipping lines made an operating profit over 2.5 years of about $500 billion. That's more than ever been made in the 60 years of container shipping, by a factor of 10, basically. So shipping lines became incredibly profitable over the pandemic. It's important to stress that the shipping lines are not price setters. They are price takers. What forced the price up was a shortage of equipment, so the containers, a shortage of capacity, and effectively the customers, the cargo owners bidding up the price where more high-value cargo, desperate to get on board a vessel, force rates up. Now, rates did come down again once the pandemic slowed down, but because of the Red Sea crisis and the shortage of capacity coming back, they've come up quite considerably over 2024.
Alan, you note that the Red Sea crisis means that any excess supply in the market has been soaked up completely, and any shock to the system has been immediate and severe, which gave the ILA, the union, some leverage. Is this why the strike was only 3 days long?
It certainly is a big part of it. If the Red Sea crisis had never happened, we would have had basically a slack of 14% of the global fleet that actually wasn't entirely needed, which meant that when the strike happened, if it had gone on for a while, certainly would have the people that have boxes on the vessels coming into port, as well as all of the containers in port, they would be massively affected. But other trades would be limited effect because you would have excess capacity to slack into. Where if we hadn't had the Red Sea crisis and a prolonged strike, we would basically have had vessel capacity locked up on the US East Coast and starting to pull it out of other trades. So it's all very much tied together. Fortunately, we didn't see a prolonged strike, but it certainly gave the ILA a very strong bargaining position that they wouldn't have in a market with much more slack.
Alan, thank you so much. It's obviously the middle of the night there in Singapore, and we much appreciate you speaking with us. That's Alan Murphy, CEO and founder of Sea Intelligence. And coming up, geopolitical turmoil driving oil prices to new highs, off the highs now since some comments from President Biden just a little earlier. We're going to get some perspective from Ed Morse, special advisor to Hartree Partners. That's next. This is The Close on Bloomberg.
It is just about 3:30 p.m. in New York. This is the countdown to the close. I'm Scarlett Fu.
And I'm Bonnie Quinn.
And of course, we're looking at oil prices. Joe Biden moving the market here, right?
Moved it yesterday and today, in fact, Scarlett. We were above 75 on WTI and back down below 75 now because he clarified perhaps what he meant when he said yesterday, we're discussing that. And that, of course, was a question posed by a reporter on whether Israel would retaliate on Iran and specifically geostrategic energy infrastructure. Right. And he said, we're discussing that, related to the question of whether the US would support that. Well, today, in fact, even though we see a fresh increase for oil prices, and this is the Brent price. You can see an 8% increase this week anyway. Well, today, President Biden said, if I were in their shoes, referring to Israel, I'd be thinking about other alternatives than striking oil fields. And that had oil come off just a little bit. West Texas Intermediate futures below $75 a barrel, but that doesn't discount the fact that they surged the most since March of last year this week, and it all comes as fears that Israel might retaliate against Iran in such a fashion rise. Here in the studio with more on all of this, and maybe he can explain it to us, is Ed Morse, Senior Advisor at Hartree Partners. So Ed, what is going on in this oil market?
Well, the oil market is obviously responding to events in the Middle East, and events in the Middle East are the worst that they have been since October 7th of last year. Nothing has happened to de-escalate, and a lot of things have resulted in escalation. But if you look at the price in the market, we've had 2 points in the last year of $90 Brent. One was right after October 7th, and the other coincided with the last big attack, tit for tat, of Iran against Israel and Israel for Iran. And then it went down steadily through the summer until it hit below 80. And that's a reflection of the real market conditions. This is a weak market. It's a weak market that has not been helped by the global economy. And even now, with the worst, most dangerous situation that we've seen in terms of disruption, real disruption of supply, the market can't even get back to 80, let alone 90.
Which is fascinating, but at the same time, you have to ask the question, what if Israel were to retaliate and on energy infrastructure? First of all, why would they? Would it be in their interest to do that? And second of all, there's plenty of supply in the world anyway, right? Libya is coming back online now. It's a question as to how many barrels it would even take off if they were to even attack the biggest of the oil infrastructure projects.
Sure. So I can't say that I can project myself into the mind of Bibi Netanyahu, but to the degree I try to do that, what he sees in front of him is the weakest Iranian government that any of us have seen for a long time. And that weakness is not just from the embarrassment of having the Mossad infiltrate intelligence and be able to kill people within Tehran that were highly under tight security, but we've had a major break in the government. We had an elected government, which is anything but what the Quds forces or the Islamic Revolutionary Guard is for. They're for dialogue. They are for peace. They are for continuity. And we have a big split in the Iranian government at a time when the supreme leader is likely not to live much longer, when there's no clear successor to him, and when the right wing, for lack of a better term, is fearful about what might happen and what their future may be. So given the divisions that are very obvious within the Iranian political system, this might be a good time to strike hard. And then the issue is not what kind of damage would be done to Iran under an Israeli strike. And yes, Iran is producing 3.6 or 3.7 million a day, and a little under 2 million of that is being exported. There's plenty of spare capacity to cover that.
Right.
There is no spare capacity to cover a closing of the Strait of Hormuz, which is, we get 14 million barrels of flow of liquids, and that's a big number.
And that feels like that's the worst case scenario here. In terms of if Netanyahu were to direct Israel to attack Iran's facilities, how would that actually work in practice? Does he need to go and get official approval from the U.S. To target those facilities, or does he just inform the White House that he's doing that? I mean, what does that look like, and how quickly could that happen?
Well, given the planning cycle, it could happen at any moment. Clearly, there was a lot of planning and going back into Lebanon. The planning had to be detailed in terms of dealing with the walkie-talkies, dealing with the bombing. And he hinted to the U.S. government he was going to do it. The one time when there was a coordination was in the missile defense against Iran, where the U.S. did shoot down missiles. But he doesn't have any obligation, and he's got a window in which this is a politically noiseless country, in that the Knesset, the parliament, went on holiday on July 24th, and it comes back on October 27th. So he's got nobody there in the parliament who's going to start screaming and saying, where are the hostages?
You mentioned blocking the Strait of Hormuz. If we get to open conflict and that strait is blocked completely, I know that you're reluctant to project oil prices, but does that tip things over where oil can reach $100 or more?
Oh, absolutely. You can't predict how high it will go. I doubt it will hit the 120 that we've seen before, nor can you predict how long it might be there. But if you hypothetically take an attack of some sort, blowing up ships in the Strait of Hormuz. You look back and they're different, but then there's a hint at it. We had a problem with a bridge collapsing, being hit by a ship in Baltimore. And it's only been in the last couple of weeks that port has come back into functioning. And that's close to a year. So, it's going to take a lot of time. Probably would not take a full year, but it would take, lots of weeks without 14 million barrels a day of supply.
Ed, it's not just oil that's being impacted by geopolitical tensions, about port strikes, by everything that's going on. I was looking at natural gas as well, and it had a huge run up this week. And then today, after the rig count came out, I guess, we're down 4.5% on the front month. Where do you see natural gas headed? There's so many conversations around things like AI powering and, oversupply. And how do you, make all that make sense?
Sure. So the first thing to look at, in terms of the U.S. at least, is that a lot of the gas is coming from associated gas in the Permian Basin. A lot of it is coming from the Haynesville. We are a gas-rich country, and we are expecting to have close to doubling of our exports of LNG. But if the associated gas does not rise, if, say, we have a below $50 oil price and companies pull back on the associated gas, the gas market could get a bit tight. But most of it would be tightness in other markets, not in the U.S. market.
And very quickly before we let you go, China announced a whole raft of stimulus measures last week. Is any of it enough for you to change your forecast based on what they did announce? No,
China's reaching zero growth in transportation fuels. Their transportation fuel growth is negative, actually, in diesel, and it's barely positive in gasoline. None of the measures deal with people buying anything, people traveling in the China economy. So I'd say they're set for the next 2 years without any massive increase in growth. They're trying to save the property system. They've got between 80 and 90 million houses for people, or residents for people, and they don't have 80 to 90 million people to fill them. So the economy is not what you'd call great shape.
All right, Ed, thank you so much as always for joining us. Ed Morse is Senior Advisor to Hartree Partners. Coming up on the close, we're taking a look at shares of Spirit Airlines hitting some major turbulence today, with shares down double-digit percentages. It is today's stock of the hour, and this is the close. It's time now for our stock of the hour, and we're watching shares of discount carrier Spirit Airlines tumbling the most since January to a fresh record low. This as Spirit's efforts to restructure its debt and avoid filing for bankruptcy stall out after months of negotiations with creditors. Bailey Lipschultz, Bloomberg News senior reporter, joins us now to discuss. And Bailey, of course, you're looking at shares of JetBlue as well as Frontier, companies that had looked into perhaps teaming up with Spirit, rallied because they're not in the same predicament. How much of this is tied to the fact that Spirit is on its own and hasn't teamed up with anyone?
No, Scarlett, I think that's the exact driver when you're a company that is years away from profitability, depending on the analyst you talk to, a company that's trying to navigate an industry in a dynamic where cost of oil and cost of fuel are up, cost of labor are higher. People who normally would fly on discount airlines are pushing back. The company has been trying to revamp its offerings, but really once that JetBlue rescue deal was taken off the table by the FTC and U.S. regulators, it really became a question of what was next for the company back then. And as you can see now, has until October 21st to reach a deal to extend or refinance those bonds. But there is a lot of uncertainty about what is next for the company. And if, again, according to that Wall Street Journal report, if bankruptcy would be the next logical step.
And Bailey, according to these sources, creditors are holding out. What are they holding out for? Would it be better for them, in fact, to have Spirit in bankruptcy protection than to give a bigger haircut?
I think there's a lot of uncertainty, Vani, about what the path forward looks like. And when you're talking about bond investors, as we know, those are the people best positioned to at least kind of pick off assets and look at what the company still has going for it. And that's why, again, we're talking about a company that's, at least from a market cap perspective, when you look at the equity, worth less than $200 million. A year ago, it was closer to $2 billion. So again, struggling with the fallout from the potential sales, as Scarlett mentioned, to Frontier and to JetBlue, and also just really struggling again with its underlying business as consumers either shift away from discount airlines or really just rethink if they're traveling at all.
So we're taking a look at other airline shares. American Airlines, United, Delta, they're all higher. What is the thinking here in terms of Spirit's pain is what their gain? Is it a zero-sum game here?
I don't know if it's that much, Scarlett. I think it could just be the fact that most kind of stocks are trading higher this morning and throughout today, as we see from the jobs data that the economy could be in a better position than many had feared. But to your point, the big question back when this was being reviewed by U.S. regulators was, what does it mean for competitive dynamics? And if you get rid of a discount carrier like Spirit Air, what does that mean for, again, to your point, the Uniteds or the Southwests of the world? We've been keeping an eye on Southwest given their kind of activist headache, if you will, where they're revamping and rethinking about their business. So they're trying to grapple with consumers who maybe don't want to pay bottom dollar to go on airlines, and the fact that the premium cabins are really where the money is being made for a number of these airlines. And that's why you're seeing, as you can see on the chart, the likes of United outperforming because of their global offerings and because they can charge more for business and first class.
Bailey, to push it a step further, I mean, can we blame this potential bankruptcy, if it does happen, on regulators? And might we see that then in other industries too, where regulators have been particularly forceful?
I don't know if we can blame them, Bonnie, but it is certainly a topic that was the first to come to mind when I was talking to sources this morning, was that if you weren't willing to let the company be acquired by a competitor and you looked at the debt load and you're willing to potentially just let the company go bankrupt, whether that results in a more efficient rethought company, rework company coming out of a bankruptcy, which obviously plenty of companies have done. But that is a great point, and that really had been the first reaction when I was talking to some of my macro investors, people who invest more at an industry level and pick stocks here and there, is what does this mean for a company that in a way could be viewed as a rescue takeover when it was being proposed, and what that could mean for other industries, to your point.
Bailey, thank you so much. Bailey Lipschultz there, Bloomberg News senior reporter. Coming up, we are counting you down to the closing bells with Nancy Tengler, CEO and CIO with Laffer Tengler Investments. This is The Close.
The wage growth in particular is one of the highlights, in my view, of what we've seen in the labor market over the past year. Wages have been growing faster than prices for the past couple years. And even as we've made this progress bringing down inflation, real incomes for Americans continue to tick up.
That was Eric Van Nostrand. He is chief economist with the U.S. Department of Treasury, kicking off the show, responding to our question about the stellar jobs report that we got today that really surprised everyone, including the most bullish estimate among economists that we surveyed.
Exactly, Scarlett, and also all of the other metrics as well, right? The wages and the unemployment rate and on and on and on. Of course, we'll get more data next week with the inflation print and then another jobs report, but it definitely set the tone, at least for equities today, and we saw that across the board. I do want to point to China equities, though, because we've been following those all week. We're waiting for China to reopen next week, but all week we saw these ETFs that track China equities. This particular one tracks the large caps. It's the iShares China Large Cap ETF, up another 3.6% today. So we'll see if that continues next week once Golden Week is finished and we start getting data from what happened during Golden Week travel-wise and so on. Then I thought it might be interesting to look at the banks because, as I say, it was across the board that we saw gains, but we have bank earnings season starting next week, and so we had a nice little bounce there for the KBW Bank Index, and it wasn't just the large cap banks, Scarlett, it was also the regionals. And then if you take a look there, the home builders, they were one area where we were lower on the day. All of the home builders lower, from D.H. Horton to D.R. Horton to Lennar to Pulte. Of course, those interest rates maybe not coming down as fast is a little bit of a challenge to those home builders. And then I was curious, what is Bitcoin these days? Is it a risk on asset? Is it a risk off asset? We ended the day up, $62,000 plus, up 2.6%.
Today it looks like it's risk on, right? Yeah. Well, for more market analysis and how this all comes together, let's bring in Nancy Tengler. She is CEO and CIO with Laffer Tengler Investments. Bonnie showed us clearly how the jobs report today was a risk-on signal to those looking to increase their appetite and risk. It did force the bond market to reprice rate cuts for later this year, really muddying the outlook. Why is it a much more clearer signal to equities?
Oh, well, Scarlett, thanks so much for having me. I think largely because it demonstrates that the economy is in good shape. And one of the things that we look at is corporate tax receipts. And what you saw for the third quarter when companies filed in the middle of September is that corporate tax receipts are up back to 2022 levels and slightly above that. And that's an indication of earnings growth. So if you've got a robust economy, we're not seeing a lot of layoffs, the labor market is in pretty good shape, then I think that's a bullish sign for equities. And that's why you saw the market move the way it did today.
With a robust economy, though, you also have the threat of inflation, and we have a big important CPI print next week. How concerned are you that the inflation story could get revived?
Yeah, I am actually concerned about that, Scarlett. If you think about the rise in oil prices and materials as China stimulated, we still haven't seen shelter come in. It's still elevated, and that's likely to remain so. Sticky inflation is still above 4%. That's the Atlanta Fed's measure. And then as you see, wages rise, that's also inflationary. Port strike looks like that was mitigated, but the hurricane in the southeast will have a short-term, I think, negative effect on the economy, and then ironically, medium term, it'll be positive as folks begin to rebuild.
Nancy, I was just looking at some of your recommendations, and one of them is AMD, and I'm curious about that because if you're going to play AI, why not just go for NVIDIA? It's a sort of a proven winner. It's, yes, up 152% so far this year, but AMD only up 15%. How long would we have to wait for that to outperform?
It's a great question, Bonnie. Listen, all AMD has to do is get the table scraps from NVIDIA, and that will drive earnings growth or revenue growth by about $2 billion. They're also, it's an extremely well-managed company and who is also following the NVIDIA playbook with the ZT acquisition. So I think it's a great way to play. It's a little bit cheaper. We do own a small position in NVIDIA, and we added both of them during the summer tech swoon, as I like to call it. So I think you just pick away at these companies, and they're, we also own Broadcom. So it's, they are the suppliers to the hyperscalers. Hyperscalers got hit because people were concerned that they were spending too much in terms of CapEx on generative AI. But as we have said, one man's CapEx spending is another man's revenue. So we think you want to own all of them if you can.
And just briefly on CAR, that CAR, Carrier Global, it's up almost 58%. It's at an all-time high, actually. This is also kind of an AI play. Nancy, explain that one to us.
Yeah, so they're the cooling, or they can be the cooling agents in data centers. And so that's been part of our investing theme, old economy companies that are pivoting or supplying to the new technologies. So the company has, they made a great acquisition a few years back, which they have integrated. And the CEO is very competent, and the company's been delivering on earnings and revenue growth. So it's one of our top holdings in our large cap equity strategy.
And for a similar reason, you kind of see Quanta, ticker PWR, as a similar beneficiary of the outsized spending on data centers.
Yeah, and on electricity, transformation of electricity. So the demands there are increasing. We saw Microsoft's news with the 3 Mile Island plant. Sorry for that. Mm-hmm. And so I think nuclear is going to be an element. We own some uranium exposure in our clean energy infrastructure strategy. But I think there's a great opportunity to broaden out your holdings away from the Mag 7 if, in fact, that's what you determine is good as an investor.
Bonnie was showing us earlier how the home builders are under pressure today because the concern is that mortgage rates won't go back down to what they might have been before the pandemic, or certainly even anything close to what would unlock a wave of buying here. So to that end, you see the home improvement retailers in a pretty good position here, ready to benefit from increased spending.
Well, we do, Scarlett. I mean, I think the market, as it has done throughout this whole hiking regime and now cutting regime, has gotten ahead of themselves. But we will see rates come down. It will be slower, but that will also encourage people to stay in their homes, which is what we've been seeing. And the spending on home improvement, Home Depot has already benefited from that as people anticipated interest rates coming down. But it's a great company that continues to grow and innovate. And so that's a member of our 12 best ideas portfolio and also part of our ETF TGLR. So it's a major holding there. And we're going to continue to hold it. I think housing is going to be a challenge for some time until the supply increases, and the supply won't increase until interest rates come down.
Yeah, it's a chicken or egg kind of situation. Nancy, always appreciate your joining us. Nancy Tengler is CEO and CIO with Laffer Tengler Investments. And I'm so glad she mentioned the housing crisis, the affordable housing crisis, because it's something that feels insolvable at this point.
Yes, exactly. And, you know, Kamala Harris has a plan, but does Donald Trump? And he sort of says he has, according to her plan and so on.
The concept of a plan, maybe?
The concept.
All right, we're moving closer to the closing bell. Full market coverage right here on Bloomberg starts now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
We're about 2 minutes away from the end of the trading day. Scarlett Fu and Bonnie Quinn here to take you through the closing bell. We've got a global simulcast, so let's bring in our radio colleagues, Carol Masser and Tim Stanovic, and we welcome all of our audiences across Bloomberg Television, Bloomberg Radio, and YouTube to parse through the most crucial moments of the trading day. I'd argue that the most crucial moment came at 8:30 a.m. before the stock market opened.
You're spot on. I just keep pulling up my rate charts on the Bloomberg because it's just amazing what we've seen in the U.S. Treasury curve. To see that 2-year now at 3.9, just below 4%. Same thing for the 10-year. So just phenomenal, the moves. But as we talked with our Michael McKenzie of Bloomberg, who follows rates, you know, he's watching CPI. Keep in mind, we've seen this before where rates move up, markets react, expectations on Fed rate cuts, you know, are reduced, but it can change on a data point.
I guess the question I have is there concern now about inflation again with a print like this? Austin Goolsbee at the Chicago Fed says don't look too much into one report, but what happens if the labor market is too strong and the Fed already cut by 50 basis points?
Yeah, I mean, that's for sure. And we're going to get some more hint about how that is going next week when we get the CPI, of course, Tim. But I'm finding it interesting that we're actually picking up steam as we go into the close, right? We're really close to our highs of the session with the S&P up 0.9% now, and those huge moves in treasuries as well.
We're going to see how everything resets next week with the CPI report and also the Fed minutes, which at this point feel kind of obsolete given the data points that we've gotten.
Very true. Although you never know what you're going to glean from these minutes, right? Or who was the dissenter or who's the person who took down their forecast.
Especially as there's some second guessing of that 50 basis point rate cut now. All right, let's take a look at how things are shaping up. As Bonnie mentioned, we are closing near our session highs. The S&P 500 up 0.9% right now. The Dow Industrials gaining 0.8% to 42,344. The Nasdaq, the winner of the bunch here, gaining 1.2%. But actually, take a look at the small caps. They're so much more levered to the economy, and as a result, the Russell 2000 gaining 1.5% on the day.
Good news is good news today in terms of the equity trade, especially for those small caps. Having said that, your best performer in the S&P 500 for the week overall, guys, Vistra Corporation at the bottom of the pack, Humana. We know the news. We covered it, down about 25%. And Scarlett, if I look at the S&P 500, most names in the S&P are higher, about 357, 146 to the downside.
All right, let's take a look at the IMAP, which shows the S&P 500 has broken down into 11 main sectors. A lot of green on that screen. It's like a spinach pie this time. There's a small slice of tomatoes.
Taken away.
Yes, that's right. Your laggards are real estate investment trusts and utilities, but they're down by less than 0.7%. And utilities, you can argue, barely lower. Financials are the best performers, gaining 1.6%. And it's not just among the big caps, it's across the board in small caps as well. Consumer discretionary and communication services also gaining more than 1%.
I'm so disappointed. It's a brat pie today.
Oh, okay. That's right. It's a brat pie. Yes.
The green.
Yeah. Oh, I know.
Come on, get with it, Tim.
Oh, spinach pie, brat pie.
A lime pie.
Yeah.
All right, let's get to some of the individual gainers. Hey guys, in homage to the bank earnings next week, Morgan Stanley on my radar up more than 3% in today's session, upgraded to buy from hold at HSBC, which says the stock's long period of underperformance versus peer Goldman Sachs and the broader market could be ending. Morgan Stanley will report earnings on October 16th. Stocks up about 15% so far here in 2024. All right, U.S. dock workers agreeing to extend their their union contract until January 15th. I know you guys have been covering it. We have too. They are keeping negotiating in terms of the next new contract. Having said that, there were some companies, you might recall, on October 1st, B of A came out and said consumer companies, staple companies like Dole and Pilgrim's Pride could be hurt as a result of a prolonged strike. So with the strike over, I took a look at Dole. That one is up about 4.5%. Of course, our bananas, can I say that, are safe. So that's up about 4.5%. Pilgrim's Pride, which is all things chicken, that one is up about 2.4%. Here's a banana. I always have a banana in the studio.
She's ready with her props.
I eat it after we have the simulcast.
You need those for press conferences.
Right? Potassium. It's really good. All right. And one more. You know I'm going to go there. Scarlett, you know I'm going to go there.
Oh, there we go. Golden Dragon Index.
There we go. Up another 3% in today's session, up more than 10% so far this week. It's up nearly 50% since late August on that wave of stimulus rounds that have included interest rate cuts, also funds to buy stocks. It is still down, though, more than 60% from a high back in 2021. But again, those Chinese names that trade in the U.S., definitely a bullish trade this week.
Okay, let's get to some of the notable decliners. I do want to start with Rivian. I kind of have like a little travel dining theme here, down 3.15%. Shares fell after the company cut its annual production target. Rivian cited a worsening supply crunch at its U.S. assembly plant. The company now expects production to drop as much as 18% this year due to an ongoing shortage of this component used to make its electric pickups and SUVs as well as commercial vans. We're talking about the R1 and RCV platforms, a component that goes on that. Third quarter output and deliveries both came up short of analyst estimates. Shares were down as much as 9% earlier in the session, but did pair some of those losses. Speaking of pairing losses, Spirit shares were down as much as 38% earlier in the session, ended up closing losing only a quarter of their value just today, down 90% so far this year, guys. It did hit a record intraday low. The efforts to restructure its debt and avoid filing for bankruptcy have hit a snag. This after months of talk with bondholders failed to result in a deal. This according to a Bloomberg News report citing people familiar with knowledge of the matter. Separately, the Wall Street Journal did report that Spirit and bondholders have held discussions over the terms of a potential bankruptcy filing. And finally, Dine Brands Global, the parent company of IHOP, Applebee's, and Fuzzy's Taco Shop, which I've never been to, but I've been to the others, I guess. They were downgraded to hold from buy at Truist Securities, cited customer concerns about sales trends at the company. Shares falling today by 2.4%.
Wouldn't be my first choice of name for a taco place. Fuzzy's Taco. Would you really want?
Yeah,
a
no,
taco?
that's not a good image.
Although it does sound very comfortable. Tell you what wasn't comfortable today, and that was Treasuries trading. I got so used to saying 3.6 something when it comes to the 2-year yield. Suddenly, I'm back at 3.9217%. That was a 21.5 basis point move just today alone. Of course, it was after the jobs data, and we might have anticipated a move like this. But wow, what a stunning move. I mean, you've got to have a really strong stomach to be a fixed income trader these days. Remember when the curve just inverted? Well, that definitely isn't happening again, at least for the moment. The 10-year yield, very, very close now to 4%. And of course, the 3-month T-bill, 4.62%. So a really stunning move there. Pricing out Fed cuts. As Michael McKee was saying earlier, we were looking at more than 10 cuts until the end of 2025. That's now down to about 6.5 cuts.
Are you guys ready for earnings? I mean, next Friday marks the start of earnings season once again.
JP Morgan, Wells Fargo, BlackRock, all next week. We got Delta Airlines, we got Airbnb, Booking Holdings, Pepsi. We got a lot coming next week.
I like the ones that are post the bell because I like watching you guys.
We like doing them. Yeah, but it'll be interesting, right? We'll start to get some commentary that we can layer on all of this economic news. We get a CPI number also, which, as our Michael McKenzie said, that is something that could change, once again, the rates narrative. He said we've been here before. He said, though, that we could see that 10-year back above 4%. So that is something. It'll keep us a little bit busy.
There's some Treasury auctions next week as well. That'll make it really interesting to see how Treasuries move.
All right. A lot of stuff to keep us busy. All right, guys, that's a wrap. Our cross-platform coverage. Have a good and safe weekend. Our cross-platform on radio, TV, YouTube, and Bloomberg Originals. Folks, we will see you again, same time, same place on Monday.
All right, coming up, Bloomberg Business Week has a sit-down with Ark Investment Management's Cathie Wood after she doubled down, invested at least $250 million in OpenAI's latest funding round. That conversation coming up on The Close, right here on Bloomberg. Welcome back to The Close. I'm Scarlett Fu.
And I'm Bonnie Quinn. And let's take a look at where markets closed out the day, because we are very, very close to our highs of the session. In fact, the S&P 500 up 0.9% at 4 p.m. 57.51. This, of course, after today's jobs data really, gave everyone a lot of enthusiasm going into the weekend. The Russell 2000, 1.5% higher. That was tracking higher than the S&P all day long. Small and mid caps stand to benefit more if the Fed doesn't perhaps have to be as aggressive with its rate cutting cycle. The two-year yield repricing a huge amount by almost 23 basis points, 3.928%. That 10-year yield is very close to 4%. And NYMEX crude, we're still higher by 75 cents, about a percentage point. But President Joe Biden did take a little bit of the air out of that particular balloon that had been, inflating since yesterday, because he did say that he thought Israel should rethink its options. There was a bit of speculation out there that perhaps Israel was thinking about targeting Iranian energy infrastructure.
All right, let's take a look at some individual equity movers as well. Spirit Airlines falling by the most ever, or I should say, falling to its lowest ever, down as much as 38%, closing at $1.69. The discount carrier doing what it can to avoid filing for bankruptcy protection. But talks to restructure its debt with creditors, they've really stalled out. The volume, by the way, was about 14 times the 20-day average. In contrast, you can see some of the other legacy carriers doing very well today. American, United, both gaining more than 6%, as did Frontier and JetBlue, which, of course, were at one point in very, very close discussions to buy Spirit Airways. Rivian Automotive, RIVN, down 3% on the day, sliding to a 4-month low. The EV maker cut its annual production target, blaming an ongoing component shortage at its only U.S. assembly plant. Now, our top story this hour is really what sparked the rally in equities, and that is the jobs report. While financial markets reprice on the back of that stellar report, we look into how companies are taking action in addressing their own needs. What does the data signal to employers about what to focus on? On top of that, what does a strong labor market mean for foreign-born professionals in the U.S. who are struggling to land a work visa? We're going to be exploring the many secondary issues tied to matching supply and demand in the labor market later on in the program.
Looking forward to that. And speaking of today's report, Scarlett, Federal Reserve Bank of Chicago President and CEO Austin Goolsbee joined Bloomberg's Michael McKee to react to America's labor market. Let's have a listen.
This jobs number today and the whole report is a superb report. You really couldn't ask realistically for a better report. I still think as a central bank, you don't want to react too much to 1 month's report.
For more on how today's data could affect the Fed's policy path as well as traders' rate cut bets, let's bring in Bloomberg reporter Vincent Cignarella. Vince, thank you so much for joining. So obviously we had this massive move today, particularly in the rate-sensitive front end, well, all across the curve, really. Just remind us, put it into context for us, how many times this cycle have we seen a repricing this big?
Probably once a week, at least in the equity markets. Not this much in the fixed income markets. Fixed income markets basically took 25 basis points on the front end of the curve straight out of Fed rate cuts. And you actually had some prominent people today suggesting the Fed made a big mistake by cutting 50 basis points at the last meeting, that maybe that was too aggressive. We'll find out in November. When the next numbers come in, as you guys mentioned on the program, we've got CPI coming up next week, PPI as well. That's going to be key following up to this jobs report to see if inflation is coming back. But clearly, looking at the numbers today, as Mr. Goolsbee just said, hard to find anything bad in those numbers. And it has the fixed income market, the Treasury market, completely repricing what the Fed is going to be doing for this year and next.
Yeah, and I agree. It seems to happen on a weekly basis, this complete repricing. You mentioned the second guessing of the Federal Reserve. Larry Summers said that the September 50 basis point cut was a mistake. Earlier this week, even before we got the jobs data, Mark Rowan of Apollo said that financing is available, real estate prices are going up. It's not clear that we need more rate cuts. So having said that, how does the bond market move forward with pricing what to expect when we do get that CPI data, given that it's still one in many data points that we're going to get before the November FOMC?
You guys were talking about 4%. I think if we see a hot print out of CPI next week, we're going to see 4% in both the 2s and the 10s. We're starting to see some narrowing of the somewhat good news because while we're pricing in higher interest rates in the short end, traders are keeping their powder dry for the back end of the curve and not as selling as aggressively. So the expectation then would be we're seeing a little uptick in rates now, but let's wait for more data because that data may suggest that there's still more easing in the future and the curve will widen once again and the short end will come back down.
Vince, if you're a trader, and you are a trader, how would you take advantage of big moves like today? I mean, do you play the move index? Do you find some derivative trades somewhere?
Well, I mean, the market was all over the place today. After the number, we were up considerably. I think the Dow was up 300. Then we went negative in the middle of the day. And now we're ending up back up at 340 at the close. I personally probably would have gotten run over today. Fading it after the numbers because the numbers would have suggested to me what it did to the fixed income market, that the Fed was maybe rushed it a little bit. I tend to follow the bond traders. They're usually the ones that are smarter than the rest of us. And I'd like to think that they got this right today and the equity market just might pair some gains next week.
Talk a little bit about the dollar, because the dollar has been up every single day this week. And of course, we know that earlier this week there was tremendous yen weakness. Then there was a lot of selling in the pound as well because of comments from leaders in each of those countries here. But how do we anticipate what a stronger dollar, if indeed we are back in a strong dollar regime, how that will impact the other asset classes?
Well, the strong dollar could be temporary. I mean, it depends on what goes on in the Middle East. It's one of the reasons why you've seen the dollar strengthen. A bit of a haven flow. It's the reason why we've seen oil up, although it's come off a little bit today. When I'm talking to traders today, they're very, very leery about going into the weekend short dollar, short oil, and even too long equities, given the possibility that tensions could flare up in the Middle East. If this is prolonged, if it stretches out and the conflict extends in Lebanon with Hezbollah, and if Iran gets involved, what the retaliation of Israel will be, all will weigh in. And if all of that adds up to something of a prolonged war, if you will, the prospects for the dollar will probably look very good going forward and not too hot for emerging markets.
Vince, how much is this a moment of change based on, what Scarlett said, these geopolitical tensions that are really coming to the fore again? They were sort of, in the background for a long time, and all of the fear over Ukraine and Russia and so on, that sort of played out in markets already. So now you have, heightened geopolitical tensions, but you also have this election, you also have, Fed and uncertainty surrounding that, and it does feel like things like Bitcoin and so on are not trading the way they were in the first 6 to 8 months of this year.
Yeah, so I think the way that plays out for markets is we're going to see a lot of churn, a lot of volatility like we saw today in equities, a lot of back and forth. It's going to be more of a jogging in place, if you will. If you look back, we're like in the S&P 500, probably where we were 2 weeks ago when that big end of quarter option was in play from JP Morgan, which held the markets in check between 5,700 and 5,750. And the cash, we're now back to that 5,750 level right where it was. So it'd be interesting to see if the markets have the appetite to push that higher next week. It appears that way going into the close. But at the same time, there's so much news that can come out and change this in a heartbeat.
Vince, do you think that we're going to continue to see momentum in Chinese stocks when the mainland markets reopen on Tuesday? I mean, it's been such just an unveiling of all these stimulus measures, but everyone we talk to says when it comes down to it, doesn't address the bigger problem, which is demand from the Chinese consumer.
Correct, and also doesn't address the real estate market in China, which is the big albatross. You can lower mortgage rates, you can make money freer, but you can't make people go out and buy a home if they don't have the wherewithal to do that. And I think there's a great, much more fiscal policy China's going to have to do to salvage that. These stimulus packages tend to be very, very positive in the short run, and somewhere within 2 months, history tells us they fade. So we may see a pickup again on Monday. It's still too new. There might be a continuation going forward into next week, but I wouldn't bet on it in the long run.
All right, so perhaps an immediate knee-jerk reaction when the markets reopen, but whether that sustains is a different issue. Bloomberg's Vince Cignarella, thank you so much for joining us. Bloomberg's Vince Cignarella, a former trader and, of course, one of our macro strategists here at Bloomberg News. And, of course, it'll be interesting when it comes to China because it was so under-owned that even just a little bit of buying will juice the gains.
Exactly. And we'll see if there'll be a follow-on for the consumer from the leadership.
All right, let's turn now away from the Fed into one of the biggest winners in the current high-rate environment, tech and AI. Let's go now to our colleagues in radio, Carol Massar and Tim Stanovic.
Television. All right, let's get to Cathie Wood joining us. Cathie, great to have you here with us. How are you?
I'm great, Carol. Thank you so much for inviting me.
Well, it's good to have you here. There is a lot going on, and we were saying, obviously, we want to kind of start macro, which we often do with you. And first up, the upbeat labor market, the Fed finally now cutting interest rates. You've been beating the drum for some time about the Fed to cut rates. At the same time, we had former Treasury Secretary Larry Summers out saying the half-a-point cut was a mistake. Stanley Druckenmiller, the hedge fund billionaire, he believes the Fed shouldn't have cut rates at the most recent meeting. He thinks that the central bank has boxed itself into a corner by guiding for even more rate cuts ahead. Do you think the Fed rate cut was a mistake?
Absolutely not. Not at all. It's been very interesting to watch the revisions in economic activity. Until this report, the revisions in the employment numbers had been down, and they were much weaker than had originally been reported. We look at earnings reports and look at their revenues, and we're seeing a lot of companies showing negative revenues. So the headline numbers are heavily influenced recently, certainly in terms of some of the upward revisions in personal income by transfer payments, that's government stimulus, and interestingly, dividends. But not if you look at the economy, the cyclical part of the economy is sick. It's sick. If you look at the sectors in the economy, one by one, they've been falling into a recession, no matter what the headline numbers say. Housing went down immediately when the Fed started raising rates. We're down 20 to 40% still. That's a recession. You've got non-residential construction in recession, autos, very weak.
Cathie, I know it's a backward-looking number, but then what do you make of today's payrolls report? 254,000 jobs added to the economy for the month of September. And that doesn't seem recessionary.
So if you just let me finish, Tim, I'll get to that in 1 minute. So we've got those sectors, and then you've got the small and medium business sector. Their confidence is at 08-09 levels. And we've got certain pricing measures, certainly the cyclical ones, that have been deflationary, actually. So one thing that I do think is going on that is helping is as prices are coming down and the consumer's getting better and better deals, and they're spending. So I think that is sustaining. A lot of people say real growth causes inflation. In this case, and actually in history, most times if you cut prices, you'll get more activity. The consumer, as long as the labor market hangs in here, and yes, today was very reassuring that way. As long as the labor market hangs in here, and companies like Walmart and Costco and auto companies either increase their discounts or cut their prices, I think the activity will come. And the labor market will continue to hang in. But if they try and jack prices back up, it was very interesting to see FedEx, after turning positive in revenues and then turning negative year over year on revenues, basically saying they're going to use prices to make it up. I think that's going to backfire. And I think during the next year, that many people will understand how deflationary the undercurrents are in the economy. Now, deflation is not always bad. Part of it is because of innovation, technologically enabled innovation. The car prices, EV prices are coming down. Their costs are coming down too. So I think there's a lot of confusion in terms of what's going on out there because productivity is stronger than expected, giving companies the latitude to cut prices and salvage margins. If that sustains, great.
Cathie, when we talked with you earlier this year, let's go back to March for a moment. You mentioned the possibility of inflation going negative this year. You also talked about unemployment going above 5%. Are those still your calls?
Yeah, this year, I mean, we're going to have to push it out because inflation did levitate as companies tried to price to make up for shortfalls in unit growth. It levitated in the 3.5% to 4% range. Now it's broken below 3%. And we're hearing more and more companies, basically trying to attract consumer attention with lower prices. So yes, if you look at money growth on a year-over-year basis, it was negative for, I think, about a year and a half, maybe more. Money is a leading indicator for inflation, and we do believe that inflation will go much lower than people expect right now. Wouldn't be surprised to see it go negative, especially if the consumer is worried about job loss, whether because of AI and automation generally, or what have you. So the saving rate tends to go up during those periods. And that will mean, we believe, that companies will have to price even more aggressively. In terms of over 5% unemployment rate, we could see it. We could see it. I will say today gave me pause in terms of this productivity dynamic and sort of companies may not, if they get the productivity growth from existing employees, they may not feel like laying them off. They can lower prices to keep consumer demand going.
Hey, Cathie, election front and center. We're just a month and change out from the election here in the U.S. And I'm wondering how this dynamic, in your view, changes whether President Trump is reelected or we see a Harris administration.
And I wonder who you would support, too, in terms of what you think is good for the U.S. economy and America.
Okay, so our focus is on innovation, and something very important happened this past year. We were very concerned that excessive regulation was driving innovation off our shores, particularly when it came to crypto or digital assets. We've had a very hostile regulator. And the same, I would say, is true of the FTC in terms of denying M&A, because that has prevented a lot of innovative companies from enjoying liquidity events by selling out to bigger companies. I think we're hearing from both candidates that those two jobs are on the line, maybe for that reason. And we're seeing more alignment that innovation solves problems. And so we should not discourage it. So from that point of view, I'm happy to see the bipartisan movement here. We'll favor lower regulations every day when it comes to innovation. I don't think tariffs are a great thing at all for innovation and for economic activity. So there's something on both sides that will give us pause. But the most important thing is the biggest impediments to innovation. We think that we're developing clarity around what's going to happen at the SEC and the FTC.
So do you think one thing is better than one of the candidates, I should say, is better for the investment environment, for companies versus the other?
So here I'm going to revert to being the CEO of a company where, I'm representing both sides, and I'm focusing, therefore, on innovation, which is of primary concern to us. And I've given you a sense of where we think both sides are on innovation. Regulations, the one that will lower more regulations, because regulations are strangling this economy, strangling small business, strangling big business. That's a very important one. tariffs would be harmful as well. So
fair enough. Well, let's talk innovation, which is your world. AI, big news this week. OpenAI's raising $6.5 billion in new funding, $157 billion valuation. Ark put in $250 million. The Wall Street Journal reminding us that that's the minimum amount required to open up their financial document. So why this investment? Why are you interested? And what did you learn about the company and its growth trajectory, or about the business, to be quite fair, looking at those financial documents?
Well, we've been doing research on AI for 10 years now. Mm-hmm. That's why we were so early into NVIDIA. And, we've obviously taken it down in most of our portfolios out of the flagship. One of the things that we've been looking for is the next big play. Mm-hmm. And we think NVIDIA is still a fine stock, but in terms of the unexpected out there, we do think it's going to be in the software layers. And as you know, Palantir has become a big position for us in the top 10. UiPath as well, it had a stumble, but it's coming back now. And I think as more and more people understand how well positioned it is, it will do very well. But a lot of the software companies that we think are going to benefit are in the private sector. And I'm thrilled that we have a venture fund that is really our purpose here is to democratize venture capital so that for $500, anyone can get access to OpenAI, which is the third largest position, or SpaceX, which is the largest position. But if you look at software, many people say, well, we have so many software companies in the public markets. What do you mean? And what we mean by that is we think that the software world's going to change fairly dramatically. And we're going to see a shift, maybe a share shift away from software as a service towards platform as a service. So think about Palantir and foundation models, and infrastructure as a service, so cloud. And the reason for that is because engineers are going to be made so much more productive, developers so much more productive by OpenAI and Anthropic and xAI and Google and Meta's Llama 3. We're going to see companies customizing their own software, for their own companies, as opposed to just going automatically to, one size fits all software as a service.
Hey, Cathie, forgive me. We only have a couple minutes left, so I want to get in.
And that was Bloomberg Radio's Carol Masser and Tim Stenavec having an in-depth conversation with Cathie Wood, founder and CEO of Ark Investment Management. I want to turn back now to the U.S. labor market as it remains resilient. Numbers from September's jobs report showed that job growth topped all estimates.
Unemployment unexpectedly declined to 4.1%, while non-farm payrolls increased the most in 6 months, gaining 254,000. That even topped the most bullish estimate out there. So we want to turn now to Debbie Dyson. She's CEO of Uneten, whose mission is to hire, promote, and advance talent who don't have four-year degrees. Debbie, great to have you with us in studio. Thank you for joining us. What does the market look like for that population of people who don't have four-year college degrees and are looking for work?
Yeah, I think one of the things that's interesting is when these job reports come out, what you have to try to start to reconcile is that there's job creation and then there's the ability to actually hire. And so when we think about individuals or talent that's out there that is looking for jobs, where I think we have an opportunity is helping them see the industries and the opportunities of the skills required for those jobs. And so as we see this interesting fluctuation of, again, job demand and job creation, it's what do we do to put talent into the right path to move that forward.
And in terms of that skill acquisition, is that something they can learn on the job, or is that something they have to come into the job with?
I think you can actually have both, because what you're starting to see is that you have individuals that are already in the seat that are actually looking to do job change and need certain skills required. And then you have new entries. So as you think about people that are obviously just getting started, whether they're coming out of college or even actually do not have a college degree, I think both paths are actually opportunistic.
One thing we know about finding a job in 2024 is that you have to submit a lot of it online. And you're not really sure if people are looking at what you submit. A lot of it goes through software screening. And even as a lot of the job listings say that you don't have to have a college degree, that it's optional, we know that sometimes software screens you out for it as well. Yeah. And so the lack of that college degree could still be an obstacle in many ways, even if it's not officially required.
Yeah, absolutely. I mean, I think we've talked about this. I don't want to call it a threat, but as you do think about automation and AI, the ability to sort of, I don't want to say feed resumes or to actually eliminate individuals, I think is a risk that we take. But, you know, the introduction of some things around just soft touches, where I do think you have the ability to still talk to talent, I think is critical so that you don't miss great talent that's looking for a great job with great companies.
Debbie, when you got the jobs report this morning, it looked like every demographic improved, that it was great news for everybody. But what did the jobs report not tell us?
Oh, that's a fantastic question. I think what it's not telling us is where. Like, what are the locations and what are the actual jobs themselves? I think we have an opportunity that as employers are thinking about the job creation is, how do you anticipate where it's going? And then for talent, how do you actually prepare for the jobs that are looking for your skills? We're never going to have a scenario, I think, where job creation and job hires will be exactly the same. But what we can do is try to forecast and predict where it's going so you have anticipation of closing the gap that sometimes is going to exist. So I think that's what was encouraging in terms of the work that we're trying to do is how do we close that gap to get employers up to speed with where talent actually is. You create the job, but do you actually have the talent to fill the jobs that you're creating?
Are we getting any better at retraining, at repurposing people for new jobs, new careers? Is there enough money out there to do that?
Yeah, I think absolutely. I mean, one of the things that we're starting to see is apprenticeships is huge. So as you think about if you're not hiring in, which, you know, there is to some degree some slowdown, apprenticeships gives employers an opportunity to reinvest in their current population. It helps with retention, it helps with engagement, and helps with those that are trying to look for a different career path. So I do think apprenticeships is another alternative to think about that instead of actually hiring.
I want to continue on that thread because we've heard about how apprenticeships is great. It's certainly very successful in countries like Germany. And I remember during the great financial crisis and afterwards, everyone talked up about how U.S. companies need to do more of this. Few companies, though, actually take action. There's a lot of rhetoric. Sure. There's not a lot of action. You actually helped Delta create an apprenticeship program that promoted hourly workers into salaried positions with a career track. What actually had to happen, though, for Delta to invest in that, to move it forward, as opposed to just saying, yeah, that's a great idea?
Yeah, I mean, I think, look, when anytime there's new opportunities that come, you do have to sort of have proof in the pudding. Like, what are the success metrics that we should be looking at to ensure that this is going to be successful? So you had support from the top. Ed Bastain was definitely on board. But even more importantly was this middle management, because it's the middle managers that actually have to support the ability for these programs to be successful. So it's all around preparation, change management, practice change, getting your existing population to help. Apprenticeships won't work if you don't have that sort of collective unit of both the apprentices coming in as well as the existing organization to support it.
So it requires a change in the culture of the company as well. And as a whole, I feel like corporate America is not quite there yet.
Yeah, absolutely. I mean, it's easy as we talk about skills first and we say, oh, well, just skills first, just remove the degrees. It's not that simple. It's never that simple. So I think we have created an infrastructure to really help. I mean, we've got 60 some odd companies in our coalition that are giving us best-in-class examples of barriers to, find or ignore, and at the same time, we sort of help you sort of maneuver through all of those things at the same time.
Debbie, what about, the fact that we work longer and longer now and people need to change career at different times in their lives? It's not just in their early 20s. It's not just maybe mid-career doesn't mean 30 anymore, right? It could mean 40, it could mean 50, or even beyond. What do you do for those people that come to you?
Yeah, I mean, look, we have 7 generations, I think, that are in our workforce right now. I mean, we've never had that phenomenon, to your point. I mean, you have people in their, 60s or 70s that were retired and decided they wanted to come back for a variety of reasons. The programs that I think we have in place are meeting you where you're at. I mean, that's sort of a little bit of our tagline. We will meet you where you're at. And there's adjustments and different variations. I mean, some people want it all online. Some people prefer in person. We have that flexibility, again, I think, to meet people where they are, to adjust as needed. So.
Are there industries that are going to look entirely different in 10, 15 years? And not just for AI reasons, but for other reasons as well?
Oh, absolutely. I mean, you can see, and I think even the job report sort of supported this. I mean, healthcare is booming, like no tomorrow. And it's been that way for the last, probably since post-pandemic, the last 4 or 5 years. So I think healthcare will be that. I think logistical services in terms of how we get delivery. I mean, we've seen, obviously, nuts, in terms of how that's actually been transforming. But I see more of that based off of, again, the trends that that we've already seen thus far.
And both of these are careers where you don't necessarily need a four-year college degree.
Absolutely, absolutely.
All right. Debbie Dyson, always appreciate your joining us. Debbie Dyson is CEO of Uneten. We're going to stay on the labor market here and give you another read on it because it comes from a gray area in U.S. immigration law. Dozens of little-known U.S. schools are offering specialized graduate programs to foreign-born residents. Little do they know, though, these programs are essentially work visas in disguise. Joining us now to discuss his reporting on this is Zach Miter, Bloomberg News reporter who's won a Pulitzer. Zach, thank you so much for joining us. You write about this thing called Day One CPT. It's a program. Can you explain what it is briefly?
Sure. It's basically a graduate degree program where you're allowed to work from the day you begin graduate classes. So if you're a foreign student, you can get a work authorization to work full-time the entire time you're in your 2-year master's degree program or what have you. And so it's essentially a work visa in disguise because even though you do have to attend some classes occasionally in person, you can keep your full-time job and keep working in the U.S.
I mean, what are the downsides, Zach? Why wouldn't somebody do that if they wanted to, move to the United States or get away from where they're living?
Right. So the real draw here is there's this huge class of people, tens of thousands every year, who are skilled foreign workers, many of them from India or China, who are already working at great American jobs. They're working at Goldman Sachs and Apple and Amazon. And they just can't stay here any longer because of immigration rules, and they can't get these skilled worker visas, these H-1Bs. And so for these people, Day One CPT might be the only way to remain in the U.S. and remain at their jobs. Their employers want them to stay. They just can't get a visa any other way.
So the schools that are offering these programs, are they for-profit schools? I mean, are they, just making money hand over fist here by doing this?
It runs the gamut. The one we focused on is a private nonprofit called Harrisburg University, but some are for-profits, some are religious affiliated. But what a lot of the big ones have in common is most of them didn't really have big graduate programs before this. And they essentially just realized, wow, there's some real money to be made by offering these programs for international students who might actually only come to campus as little as 2 days out of the year.
Yeah, I mean, it seems so odd, Zach. How is this getting past the authorities? I presume it is legal, but if it's so legal and so easy, then why isn't everybody doing it in some ways? Right. So, the federal immigration authorities are certainly aware of this. They've never really formally blessed it, but they haven't shut it down either. And so it's been going on now for 10 years, but it's really gotten big in just the past few years when there's been just a steep rise in the number of people who need this kind of service because there's just a very limited number of these skilled worker visas, and the number of skilled workers from India and China who are coming here just keeps growing and growing.
So quickly, Zach, let's say that you go through this program, you get a master's degree, but you're still not able to get a work visa through the lottery. Then what? What do you do as someone who's in the U.S. but doesn't have citizenship and legal rights to work here?
Believe it or not, you might get another master's degree. We've heard stories of as many as 5 in a row. Some people get their Day One CPT doctorate. There are all different ways, and it's because the immigration system is just so not prepared to deal with the kind of supply and demand that people are forced into these kind of loophole solutions to remain in the country, remain at their jobs.
That's a fascinating story. Zach, you always find them. Our thanks to that is Zach Miter, Bloomberg News reporter.
All right, let's take a look at how markets ended the day, because Peter Chur of Academy Securities called it initial joy in equity land when he saw the non-farm payrolls numbers, which was better than expected across almost every metric. And for equities, it means it's good news because the Fed is still cutting rates even as the economy grows. For the bond market, it was a complete repricing of rate cuts going forward. You could see the 2-year yield moving up to 3.92%. That's a 21 basis point move in one day. Stronger dollar here as the Fed does not need to cut rates as much, and screwed remains elevated as we head into another weekend, unsure of whether Israel will retaliate against those strikes from Iran. This is the close. Many Americans are trading their corkscrews for their thumbs and fingers. Consumers are spending more than $10 billion on ready-to-drink products. We're talking about canned wine, spirits, and hard seltzers. And brands like Maker Wine are looking to capitalize on this thriving industry. Founded by 3 women, Maker Wine is an up-and-coming premium wine company that partners with women and underrepresented winemakers. Each can is eco-friendly and has a specific signature design tied to the producer that crafted it. Maker has the backing from the likes of the Chainsmokers and Odell Beckham Jr. And earlier this week, United Air said it'll add Maker cans to its domestic economy cabin wine list. This is all part of today's Next Up, where we highlight the entrepreneurs and founders moving the needle for our economy, markets, and technology. Here on set with more on this are 2 of the co-founders of Maker Wine, Sarah Hoffman and Kendra Kawala. Great to see you guys. Thank you for joining us.
Great to see you. Thanks for having us.
So you're entrepreneurs, which means that you identified a problem and you came up with a solution. Sarah, talk to us about the problem that you identified and how you chose to solve that.
Definitely. We felt like the traditional wine world wasn't speaking to us as consumers, and we really wanted to make wine more approachable and accessible and really highlight the stars of wine, independent winemakers. I had also had a background in craft beer and had seen cans really take off in that industry, and thought someone should apply this to fine wine and really use that canvas of the can to tell the story of the winemaker.
But there's a stigma against things that are in cans. You know, premium wine and can don't necessarily go together. Kendra, talk a little bit about how you overcame that.
Absolutely. Consumer education, both around the can being a format that can support premium wine, and also the quality of the wine that we put into cans, has been a big part of our journey and story over building this company. We actually source wines from independent winemakers, as Sarah mentioned, and we're proud to have the highest rated canned wine on the market. We've entered our wines into best-in-class wine competitions, New York International Wine Competition, SF Chronicle, Wine Enthusiast, and we have more than 15 wines with 90+ point scores and more than 40 wines with gold medals.
So how do you do it? How do you beat out the competition? Because yes, it's novel, but people are there, right? There are many companies that have wines in a can, Nomadica, Graham and Fisk, and so many more. And I'm sure you have a strategy to beat every single one of them. What's the difference? How do you differentiate yourselves?
Absolutely. I think firstly is quality. The juice speaks for itself, and sommeliers, judges are there to back it up. And then secondly is the story. We really put the heart and soul of wine and why people fall in love with the wineries and the wines in the first place. So every can has the name and signature of the producer who made it and a QR code on the back that pushes to more information about their story.
How did you decide what price point you were targeting?
We really wanted to be in the premium end of the market because we're highlighting award-winning winemakers that are making minimal intervention, organic, sustainably farmed wines. And when we ask our customers, we have a really large online audience. We ask our customers what they're looking for. They're really looking for that premium wine, that story, and wine that's made the right way.
And when it comes to the size, too, this is something that's very well thought out as well, because each can is 1/3 of a bottle, so it's kind of like a single serving without having to buy a bottle of wine and realizing that
that's your single serving, Scarlett?
We call it a hefty
I'm giving away a little too much.
I'm not saying that that's too little or too much. I'm just,
clarifying. Yeah, but can you talk a little bit about that, because that requires a lot of consumer research and thinking through the small stuff.
Absolutely, and everyone's had that experience where you open a bottle of wine and you have one glass and end up throwing the rest away. And so we really see that our customers love the single serving nature of canned wine, and that's been a big piece of why we've been successful.
So I have a child who just turned 21 years old, and he and his friends don't particularly like drinking. They don't necessarily like drinking wine, certainly. And that's, I think, something that a lot of Gen Z, kind of gravitates away from. They're more into cannabis. They have their other vices, so to speak. How much of this is a play for this demographic?
So we really did start the company for a consumer much like ourselves, millennial women, but we definitely see that the product speaks to Gen Z. And I think what we see is that consumers are drinking differently and looking for different things out of their product experiences. So with Maker, we lead with transparency. around where the wine came from, who made it, and certainly the ingredient list. All of our wines are fermented to dry, less than 1 gram per liter of sugar. And then secondly, the quality of the wine. We see a consumer demographic really coming into purchasing power that cares a lot about quality and is much more health conscious than their predecessors. That being said, canned wine does resonate with all ages and demographics, so it's certainly not wine for young people only.
You, according to the latest figures that I've seen, have raised $2.3 million from 30 investors. It may have changed by now, but how do you operate such a massive operation and scale with that kind of money? Or how are you getting your hands on more operating cash?
Absolutely. So we've been fortunate to be backed by some of the best in the business, from venture capitalists like Pear VC and Marcy Venture Partners down to celebrities and athletes. And candidly, these are people who are attracted to both our unique business model of highlighting independent winemakers and also our quality and the product where it lives and breathes. So one of the things that kind of makes Maker stand out is we sell into many arenas and venues across the West Coast. We're at numerous NBA arenas, the homes of the Warriors, the Clippers, the Kings, in addition to high-end hotels and resorts. And so we're really growing the pie and expanding the use cases where canned wine can be enjoyed. And I think investors have seen that.
Give us the secret sauce. How did you do that? Because come on, we know everybody has a story, right? And everybody has their niche and the way they're marketing, and they all want the premium price point and so on. That could be said about a lot of brands. How did you get into those arenas and into United?
I think our secret sauce was we actually launched the company during COVID, during the pandemic. And so we had to lead first with direct-to-consumer e-commerce. And even today, we sell more canned wine online than anyone else in our category. So we have this very direct relationship with our customer. We have thousands of members in our Can Club online. And this has allowed us to back into and really push into wholesale with a focus on more premium, more strategic placements and partnerships. I think that's the secret sauce.
Sarah Hoffman and Kendra Kawala, thank you so much. Co-founders of Maker Wine. You can find it on a United Airlines flight near you.
Oh, there you go, Scarlett. Yeah,
perfect serving size.
Or you could join the club, right? Still ahead. What investors need to watch for tomorrow. This is Bloomberg.
All right, an end of a banner week here. So let's set you up for what people are watching for next week. And we start off kind of slow on Monday. There's consumer credit. In the afternoon, the Supreme Court fall term begins. Things start to really get going on Tuesday. Amazon Prime Day begins, Bonnie.
Oh my gosh, that's something that I really need to keep an eye out for because I will be shopping. Boeing also announcing deliveries. We have to see what happens there. And then early voting begins in several states, including Wyoming and Indiana.
Yeah, definitely one to keep an eye on. There's also Pepsi earnings on on Tuesday, but that leads us to Wednesday, where we get the FOMC minutes. Normally, I'd say this is a big deal, but less so given the blockbuster jobs report that we got.
Yeah, I was trying to find a little bit of a silver lining earlier, but I think you're right, Scarlett. I think we know everything about what's in this minutes, except for maybe some details around the dissent. But we've got a lot of those already. Thursday, we get the robo-taxi event. Is that going to be the highlight of the week?
There's also something at 8:30 a.m., the CPI report, which will give a cleaner read on inflation. Certainly, that's back in the forefront of investors' minds after the big jobs report today.
And of course, we get some Nobel Prizes next week. Literature on Thursday and peace, the Nobel Peace Prize on Friday. Quite a time to be getting out of peace
earnings.
Oh gosh,
earnings
really?
Season begins. Yes, JP Morgan, Bank of New York, Wells Fargo, BlackRock, all reporting on Friday. That does it for us. Balance of Power is up next. Have a great weekend, everyone. This is Bloomberg.